RODHA account. 8. Currency and Commodity Futures Chapter 1. Currency Basics Chapter 2. Reference Rates and Impact of Events Chapter 3. Impact of Events Brexit and Interest Rate Parity Chapter 4. The USD-INR Pair Part 1 Chapter 5. The USD-INR Pair Part 2 Chapter 6. Your GBP and JPY Chapter 7. Gold Part 1 Chapter 8. Gold Part 2 Chapter 9. Silver Chapter 10. Crude Oil Part 1. Digging the Past Chapter 11. Crude Oil Part 2. The Crude Oil Ecosystem Chapter 12. Crude Oil Part 3. The Crude Oil Contract Chapter 13. Copper and Aluminum Chapter 14. Lead and Nickel Chapter 15. Cardamom and Mentha Oil Chapter 16. Natural Gas. About. Pipe. Login. Open a ZERODHA account. Chapter 1. Currency Basics. 1.1 Module Orientation. At the onset, let me give you a quick orientation, so you can set your expectations for this module. The focus of this module will be on 3 main topics: currencies and currency trading, understanding commodities, interest rate futures. I agree that each of these topics is vast and commands an entire module on its own. However, these assets are not as liquid as equities. We are still at a very nascent stage when it comes to trading these alternate assets in India. Given this, the idea here would be introduce these assets, familiarize you with what drives these assets, and what you need to watch out for before placing your trades. So, in a sense, you could consider this module as a thought starter of sorts for trading these alternative assets. Needless to say, we will try and discuss these topics to a reasonable depth, ensuring you have more than just the bare basics on these topics. We'll begin the module by discussing currencies. We'll discuss some of the popular currency pairs traded in India such as USD-INR, GBP-INR, and INR-JPY. We also discuss other non-INR currency pairs such as EUR-USD, GBP-USD, and USD-JPY. The discussion on currencies would be spread across a few chapters. The objective here would be to introduce these currency pairs and familiarize with not just the contract specification but also with a few fundamental factors that affect these currencies. Once this is done, we'll move on to the next part of the module. This deal with commodities. We'll follow a similar template here, i.e., introduce the commodities both agri and non-agri and familiarize you with not just the contract specifications but also a few fundamental factors which would influence the movement of these commodities. Some of the commodities we'll be discussing would be gold, silver, zinc, aluminum, crude oil, natural gas, turmeric, cardamom, pepper, cotton, etc. Of course, the formula to calculate the price of commodities such as gold, based on the price of gold in international markets, will also be discussed. Lastly, this module will discuss interest rate futures (IFR), which I think is a very exciting space. The discussion would deal with topics related to RBI's borrowing pattern, issuance of sovereign bonds, listing on NSE, and eventually trading them, based on how we progress. We can even touch topics related to bond trading and bond trading strategies. As you see, we have some really interesting stuff lined up. I believe this'll be a great learning experience for you and me. Please note the prerequisites for this course: futures trading, options theory, technical analysis. The above-mentioned topics are absolutely essential before learning about currencies. I'd suggest you brush up these topics before proceeding. Let's now begin this module by discussing few basics about currencies. 1.2 Currency Inequality. Before we get started on currencies, let me share with you an interesting conversation I had with my 6-year-old daughter. Perhaps this could set a good starting point for our discussion on currencies. Slightly smiling face. I had recently been to Austria with my family on vacation. As you can imagine, the country is extremely beautiful. It was my daughter's first visit to Europe and she was in complete awe. Needless to say, she was attracted to all the small little stores selling pretty little things. On one of the days while we were there, she forcibly took me to this toy store she spotted off the street, and I knew I was in for trouble. After spending about 5 to 10 minutes scanning through the shop, she finally picked up a colorful wooden caterpillar, and she wanted me to buy her that. It looked really nice, and I was willing to buy her that, until I saw the price. The wooden caterpillar had a €25 price tag. I thought I'd negotiate with her and buy her something else. I tried telling her that it was €25, and €25 was quite steep, especially for a tiny wooden caterpillar. She obviously didn't understand my point, and refused to budge from her stance. In fact, she said, "It's just €25. And I realized that she equated €25 to 25 rupees. Completely oblivious to the fact that she needs to multiply each euro with 78 to get the exact rupee equivalent. However, this got me thinking, why isn't €1 or for that matter $1 equal to 1 rupee? More generally, why isn't one unit of currency belonging to country A equivalent to another unit of currency belonging to country B? I understand this may sound very basic and some of you may already know the answer, but I think it is very important to discuss this and understand why the inequality between currencies exists. After all, it is this inequality which allows us to trade the currency pairs. To understand this, we need to brush up a bit on the history of currencies and how currency trading evolved. Don't worry, I won't get into history lessons here. We'll restrict this to a quick recap, slightly smiling face, for the sake of simplicity. Let me break this down into different stages for you based on my own understanding of the evolution of currency. Stage 1: the Barter Era. Before the advent of currencies, transactions occurred through something called the barter system. Barter system is a method of exchange which has existed for many centuries. In a typical barter, people exchange goods for other goods or services. A classic example would be, say a farmer has harvested cotton. He could exchange or barter cotton with another farmer giving him wheat. Similarly, a farmer who has oranges could exchange the oranges he has harvested with someone who agrees to wash his cows and sheep. The problem with the barter system was the scale and divisibility of the system. For example, assume a farmer had 5 bales of cotton and he wants to barter cotton with someone selling cattle, assuming 2 bales for 1 cow. After the barter, he'd be left with 2 cows and a bale of cotton. He would certainly not get half a cow for 1 bale of cotton. This caused a divisibility issue within the system. The scalability was also an issue with the barter system. It required our farmer to travel from one part of the country with all his produce to another part of the country to barter for goods of his choice. Both these issues were eventually overcome with an improved system, goods for metal. Stage 2: goods for metal era. The problems that plagued the barter system eventually paved way to the next transaction methodology. People tried to invent a common denominator for the exchange. The common denominator ranged from food grains to metals. But eventually metals thrived for obvious reasons. Metal was divisible, easily movable, and metal had no issue with shelf life. Further, of all the metals, gold and silver were the most popular. Therefore, eventually these metals became the standard for transactions. The direct exchange between gold, silver, and goods lasted for many centuries. However, things started to change when people deposited gold and silver coins in safe havens and issued paper against the value of gold. This paper derived its value based on the gold-silver coins deposited in safe haven. With time, safe havens evolved to banks and the paper transformed to different currencies. Perhaps this was the start of the book entry of the currency system. Stage 3: the gold standard era. Over time, as domestic trade flourished, trading across borders also flourished. Economic sense prevailed and merchants realized producing everything locally did not make sense. Merchants started exploring cross-border trade. Simple import and export of goods thrived. This also meant merchants transacting across border also required to pay for it in a currency that was acceptable across borders. Banking systems also evolved, and somewhere around the late 19th century exchanging goods for gold, not silver, became the norm. Valuing the local currency against the value of gold was called the gold standard. As things progressed, geopolitical situation changed. World wars, civil wars, Cold Wars, etc., and so did the economic situation across the world. When it came to cross-border transactions, there was an urgent need for merchants to trust one currency and value their own currency against that currency. This is when Bretton Woods system came to the picture. You can read more on the Bretton Woods system. However, here is a simplified version of the Bretton Woods system, BWS. The BWS was a way of defining the monetary relationship between countries, where the currencies were pegged to USD at a fixed rate while the value of the USD itself was marked against the value of gold. Countries accepted this system with a room for 1% variation either side against the pegged value. Needless to say, with BWS in place, the USD became the currency the world transacted in. As USD was backed by gold, developed countries slowly withdrew from the BWS system and eventually BWS became history. Countries adopted a more market-driven approach, where the market decided the value of one currency against the other. The market drives the value of currencies based on the political and economic landscape of a country versus the other. This brings us to where we are now. 1.3 International Currency Market Forex. Internationally, the notional currency trading volume is massive and needs a moment to digest the figure. As per the April 2013 survey conducted by Bank of International Settlement (BIS), the size of international markets stands at $5.4 trillion. Here is the link for the detailed report. My guess is we could be close to $5.80, $6 trillion as of April 2016. If you can imagine, this is roughly 20% higher than the entire Indian annual GDP that gets traded on a daily basis. Probably what really contributes to such massive trading is the fact that currency markets chases the sun. Currencies are traded across all the major markets, and information flows seamlessly. To understand what I mean, keep the Indian markets as reference and think about it before Indian markets are open. The Australian, Japanese, Hong Kong, and Singapore markets are open. In fact, we get some overlap with these markets. While the Southeast market closes, Indian markets would have just warmed up with Middle Eastern markets opening up. This leads to the European markets opening up, London, Frankfurt, and Paris being the financial nerve center of the Europe. In fact, Indian markets are situated in a sweet spot as our time zone overlaps with major Southeast Asian markets and the European markets. Finally, the US markets open, followed by the Japanese markets, and the cycle continues 24 hours a day, 6 days a week. Having said that, the most active time for currencies is when the US, UK, Japanese, and Australian markets are open. This is when the order flow gets brimful. This leads us to an interesting question. Who are these people trading currencies and why are the notional values so crazy? More importantly, how are currencies traded? Unlike equity markets, the participation in Forex is not just restricted to investors and traders. The participants in the foreign exchange Forex markets are many: central banks, corporate banks, travelers, and of course traders. Each of these participants have their own agenda while participating in the Forex markets. For example, the corporate may be buying, selling USD to hedge their order book, and a traveler may be buying USD for his travel expense, while the trader may be just speculating on the movement of the currency. Obviously, since participation comes in from many quarters, the volumes are driven up. More so, Forex trading is highly leveraged. Hence the notional value appears large. There is no centralized international exchange where the Forex transactions take place. Transactions occur at different financial institutions like NSE in India, and information flows from one platform to another, making it borderless. 1.4 Currency pairs and quotes. The standard practice while trading currencies is to trade the currency as a pair. The value of the pair keeps fluctuating as the trades flow through. An example of the pair could be USD INR or GBP INR. The currency pair has a standard format, as shown below. Base currency, quotation currency equals value. There are 3 parts here. Let's figure out each one of them. Base currency. Base currency is always fixed to one unit of a currency, like $1 US, 1 Indian rupee, 1 euro, etc. Quotation currency refers to another currency which equates to the base currency. Obviously it can be any currency apart from the base currency. Value indicates the value of the quotation currency against the base currency. Confusing? Let's take an example to make it clearer. Assume USD INR equals 67. The base currency here is USD. And as I mentioned earlier, the base currency is always fixed to one unit. Hence this is fixed to $1 US. Quotation currency is in Indian rupees INR. Value is 67, which means for 1 unit of base currency, i.e. 1 United States dollar, the equivalent quotation currency is 67. In simpler terms, $1 equals 67 rupees. The most active currency pairs that get traded across the world and its current value is on June 3, 2016 are as follows. SL No base currency quotation currency pair value. 1 euro US dollar, your 1 United States dollar and 11 cents. 2 US dollar Japanese yen USD, 108 Japanese yen and 94 cents. 3 Great Britain pound US dollar GBP, 1 United States dollar and 44 cents. 4 Australian dollar US dollar odd, 72 United States cents. 5 UD dollar Canadian dollar USD, 1 Canadian dollar and 31 cents. 6 US dollar Swiss franc USD, 99 Swiss rappen. Now here is the big question. What makes the pairs move? Why do they move? Are there events that influence the pairs? We will explore this in the next chapter. Key takeaways from this chapter. The gold standard system of evaluating currencies existed for a long time, but eventually got phased out. The currency inequality between currencies exists because of political and economic differences between 2 countries. By volumes, the currency markets is easily one of the largest. The currency markets are open 24 hours, 6 days a week. Currency is traded as pairs. Currency pairs have a standard format to include base currency and quotation currency. The base currency is always fixed to 1 unit. 65 responses to Currency Basics. KIDVERDHAN. June 7, 2016 at 12:23 p.m. Hi. Open a ZERODHA account. Chapter 2. Reference rates and impact of events. 2.1 Dual view. Think about a stock. Infosys, for example. When you buy or sell Infosys, your view on the stock is straightforward. You are either bullish or bearish on Infosys, therefore you buy or sell Infosys. Now think about a currency pair, say USD INR. When you buy or sell USD INR, whether you know or not, you have a dual view on the pair. For instance, when you buy USD INR, it implies you are bullish on the US dollar and bearish on the Indian currency. Why is it this way, you may ask? Well, the value of a currency is always quoted against another. Recall from the previous chapter, the currency pair is quoted as base currency, quotation currency equals value. In other words, this format tells us how many units of quotation currency one can buy for 1 unit of base currency. If you buy a currency pair, clearly it implies that you expect the value of the pair to go up. Consider this example, USD INR equals 65. One would buy the pair, hoping for the price of the pair to hit 68. Now if the price of the pair is expected to increase, then it implies that going forward one unit of base currency can buy more units of quotation currency, i.e. one United States dollar to buy more INR. In other words, if the value of the pair goes up, then the power of the base currency goes up, while at the same time the quotation currency weakens. This translates to you being bullish on the base currency and bearish on the quotation currency at the same time. Similarly, if you sell the USD-INR pair, it implies that you anticipate the base currency to buy lesser amount of quotation currency. This translates to you being bearish on base currency and bullish on the quotation currency. Given this, strengthening, weakening of a currency refers to the following situations. Base currency strengthens when it can buy more units of quotation currency. For example, USD-INR moves from 67 to 68. It means the base currency, USD, strengthens and the quotation currency, INR, weakens. Quotation currency strengthens when the base currency buys lesser units of quotation currency. For example, USD-INR moves from 66 to 65. It means the base currency, USD, weakens and the quotation currency, INR, strengthens. Note that strengthening and weakening of a currency is equivalent to a currency appreciating and depreciating. These terminologies are often used interchangeably. Before we proceed, here is something you need to know. Just like a stock, the currency and the currency pair has a two-way quote. The two-way quote enables one to identify the rate at which one can buy and sell the currency and currency pair. Don't get thinking on the two-way quote. It simply refers to bid and ask rates J. But we do need to touch upon this as it's vital to know how the two-way quote works. Have a look at the image below. This is a snapshot of the currency spot rates, as quoted on a Forex trading site. For the sake of this discussion, I've highlighted the two-way quote for your USD and GBP USD. The quote gives you the rate at which you can buy and sell the currency pair. For example, if you want to buy the Inr USD, you'll have to buy the pair at the ask price, i.e. 1.1270. When you buy the pair, technically you are long Inr and short USD. Likewise, if you want to sell the Inr USD, then you would do so at 1.1269 bid price. And here you would be short Inr and long USD. Remember the dual view concept. The pairs are sometimes quoted in a short form, which is actually quite a popular way to quote currencies internationally. The shortened two-way quote would be something like this for the Inr USD pair. Inr USD 1.126970. If you notice in the shortened version, the bid price is stated in full, but only the last two digits of ask is stated. Further, in the Forex lingo, digits are referred to as pips. Therefore, if the EUR/USD moves from 1.1270 to 1.1272, then it means that the pair has moved 2 pips. 2.2 rate fixing and conversion path. As of today, the USD-INR rate stands at 67.0737. This rate is fixed by the RBI on a daily basis, and is called RBI's reference rate. In fact, RBI publishes these rates on a daily basis on their website. The reference rate acts as crucial input for the currency futures trading, as all settlements are based on this reference rate. Have a look at this. The above is a snapshot from the RBI's site showing the reference rate for the 14th of June 2016. Denote: these are spot rates, and not future rates. Future rates are as seen on NSE's website. Anyway, the obvious question is, how does the RBI arrive at this rate? Well, nothing high-tech here. RBI follows the age-old method of polling to arrive at the spot rate. Click here to see the RBI circular that explains the rate fixing procedure. But if you are in no mood to read the circular, you could read the following points that summarize the procedure. RBI has identified a list of banks based on their market share in the foreign exchange market. RBI calls them the contributing banks. Every day between 11:30 a.m. and 12:30 p.m. RBI calls a set of banks randomly selected, listed under the contributing banks, and asks them to give a two-way quote on USD-INR. RBI collates these rates and averages out the rate based on the bid and ask. The average rate is set as the USD/INR rate for the day. The same process is repeated every day except for weekends and bank holidays. It's as simple as that. The procedure is quite simple. However, RBI polls only for the USD/INR rates. For the other major rates, i.e. Euro INR, GBP INR, JPY INR, RBI adopts a technique called crossing, also referred to as the cross-rate mechanism. While crossing, the direct rate of one currency is not available with respect to another. For example, the direct rate of Euro with respect to INR is not readily available. One needs to cross these rates with a common denominator to arrive at the rates. Let me take the example of deriving the Euro INR rate by crossing, keeping USD as the common denominator. Hopefully this will give you a better clarity on the crossing technique. Let us begin with getting the spot rate for USD/INR. As we can see from snapshot above, the USD/INR spot is USD/INR 67.0737. This is the spot rate. The two-way quote for this would be something like this. USD/INR 67.0730, 67.0740. This means if I have to buy one United States dollar, I need to pay INR 67.0740, and if I have to sell one United States dollar, I'd receive INR 67.0730. Let's keep this information aside. We now focus on Euro USD spot rates from the international markets. The two-way quote from Bloomberg suggests Euro USD 1.113440. This means I'd need USD 1.1140 ask price to buy 1 euro. In other words, the cost of 1 euro in terms of the US dollar is 1.1140. Hence, if I convert the price of 1.1140 USD to INR, then I will have enough INR to buy 1 euro, and by doing so, I will also get the Euro INR rate. Now going back to the USD INR rate. 1 United States dollar equals 67 rupees .0740. 1.1140 USD equals how many rupees? Equals 67.0740 asterisk 1.1140. Equals 74.72044. Hence, to buy 1 euro I'd need 74.7240 INR. Or your INR equals 74.72400. Notice how the USD acts as a pivot in the crossing technique. Now here is a simple task for you using the crossing technique. We have calculated the ask price of the Euro INR pair. Can you extend this logic to calculate the bid price for the Euro INR pair? Feel free to post your answers in the comments section below. If you think about this, it's now clear that the reference rates and the cross rates change every day based the sentiments of the contributing banks. This leads us to a bigger question: what influences the sentiment of the contributing banks? The answer is quite simple: domestic and international events. 2.3 events that matter. Think about an event that can potentially change the sentiment on a stock. Quarterly result of company is one such event. Estimating the change in sentiment based on this event is quite straightforward. If the quarterly result is good, the sentiment is positive. Therefore, the stock price is expected to go up. Alternatively, if the quarterly result is not great, sentiment is hurt and therefore the stock price is expected to go down. The point here is, there is some sort of linearity between the event and the expected outcome. However, when it comes to currency pairs, there is no such linearity, which makes it a Herculean task to assess the impact of events. aka fundamentals on currencies. The complexity mainly stems from the fact that currencies are quoted as pairs. While some factors lead to strengthening of a pair, an event could occur at the exact same time that weakens the pair. Let me give you an example to illustrate this. Imagine two economic events running in parallel. Event 1: India receives a continuous inflows of foreign direct investments, FDI, geared towards long-term investments. Clearly, this is a big positive for the economy and therefore it tends to strengthen the INR. Event 2. There is an uptick in the U.S. economy, or a fear of a crash in commodities, leading to an appreciation in the U.S. dollar. Given these two events occur in parallel, which direction will the USD-INR currency pair move? Well, the answer to this is not straightforward. Eventually, the currency pair will take cues from the more dominant of the two factors and head in that direction. But until this happens, the pair invariably exhibits volatile behavior. Hence, to successfully trade currencies, it becomes extremely important to track world events and assess their impact on the currency pair in question. Here are a few such events and data that you should track. Import-export data. These numbers are highly significant, especially for a country like India, whose economy is highly sensitive to trade deficits. India exports goods and services such as rice and software and imports commodities such as crude oil and bullion. In general, increase in exports tends to strengthen domestic currency and increase in imports tends to weaken the domestic currency. Why if so, you may ask? When imports are made, crude oil for example, the purchase has to be made in the international market, which requires one to pay in USD. Therefore, one has to sell INR and buy USD to facilitate this purchase, which in turn causes a demand for USD and hence USD strengths. We can extend the same logic to exports. When we export goods, we receive USD. We sell the USD received and convert to INR. This causes the INR to strengthen. The trade deficit, the excess of imports over exports, is a key factor to track as it influences the direction in which the currency trades. In general, narrowing the trade deficit is a positive for the domestic currency. The trade deficit is also referred to as the current account deficit. I'd suggest you read this news piece just to reinforce your understanding on this topic. Interest rates. Typically, investors borrow money from countries where Interest rates. Typically, investors borrow money from countries where the interest rate is low and invest in countries where the interest rates are high and profit from the interest rate difference. This is called the carry trade. Clearly, the country offering higher interest attracts a lot more foreign investment into the country. Naturally, this leads to the strengthening of the domestic currency. This clearly implies that the interest rate is one big number currency traders watch out for. The Monetary Policy Review conducted by the central banks, RBI in India, Federal Reserves in US, and ECB in Euro region, reviews the interest rates of the country. This is the reason why there is so much attention paid for the policy review. Besides tracking the actual change in numbers in the ongoing review, the market participants look for cues regarding the policy stance. The monetary stance helps the participants understand the future course of action concerning the interest rate. Dovish. Dovish is a term used to describe the central bank's stance wherein they're likely to lower the interest rate in the future. Remember, lower interest rate weakens the domestic currency. Here is a new headline talking about the relationship between a dovish stance and the currency. Click here to see the article. Hawkish. Hawkish is a term used to describe the central bank's stance wherein they're likely to increase the interest rate in the future. Remember, higher interest rates attract foreign investments to the country and therefore strengthens the domestic currency. And here is another new headline which talks about hawkish stance. Inflation. Inflation as you may know, is the rate at which the prices of basic goods and services increase over time. If inflation increases, then it means the cost of basic necessities is increasing. Therefore, this affects the day-to-day living of the common man. Given this, the central bank strives hard to keep inflation in control. The link between inflation and currency movement is a bit tricky. One of the direct mechanisms to curb inflation is by tweaking the interest rates. If the inflation is perceived as high, then the central bank is likely to take a hawkish stance and increase the interest rates. What do you think is the logic here? Well, easy money in the hands on consumers and corporates increases spending. When spending increases, merchants smell an opportunity to make higher margins, and therefore this leads to rapid increase in prices. And thus, the inflation increases. When inflation increases, the central banks tend to curb the spending by cutting the access to easy money. And how do they do that? Well, they increase the interest rates. Therefore, when inflation is on the rise, expect the central banks to take a hawkish stance and increase the interest rates. Therefore, as I mentioned earlier, the relationship between interest rates and currencies is a little tricky. So traders eagerly track inflation data to figure out what the central banks are likely to do, and accordingly take positions on the currency pair. Remember this: if the inflation is high, expect a hawkish stance by the central government, and therefore expect the domestic currency to strengthen. Likewise, if inflation is low, expect a dovish stance, as the central bankers wants to encourage spending. Therefore, the interest rates are likely to come down. This leads to the domestic currency weakening. Consumer Price Index, CPI. The CPI is a time series data averaged out to capture the prices of basic goods and services. Hence, the CPI is a measure for inflation. A rising CPI means inflation is increasing, and vice versa. For the most accurate Indian CPI data and information, check this website. Gross Domestic Product, GDP. The GDP of a country represents the total rupee value for Indian GDP, of course, of all the goods and services produced in the country for a given year. As you can imagine, the GDP would be a massive number, and it does not make sense to repeat the GDP number while making estimates or during conversations. Therefore, one always refers to the GDP as a growth rate. For example, if the GDP of a country is 7.1%, it means that the GPD number is growing at a rate of 7.1%. Higher the GDP growth rate, higher is the investor confidence in that country. Therefore, the stronger the country's domestic currency. The list of events that matter while trading currencies is virtually endless. And at some point you will realize that every piece of data you can possibly look at is interconnected with one another. Honestly, you need not know the details of each event the way an economist would. Understanding the cause and effect relationship is good enough. I've listed some of the key events, data points that matter while trading currencies. I guess this would serve as a good start. If nothing more. Key takeaways form this chapter. The base currency is said to strengthen, appreciate against the quotation currency when it can buy more units of quotation currency. The base currency is said to weaken, depreciate against the quotation currency when it buys lesser units of the quotation currency. When you go long on a currency pair, you are essentially going long on the base currency and short on the quotation currency. When you go short on a currency pair, you are essentially going short on the base currency and long on the quotation currency. The RBI sets the reference rate of USD/INR on a daily basis by conducting a poll. The contributing banks participate in this poll. The reference rates for other currency pairs are derived by crossing technique. Understanding events and its impact on currencies is complicated, simply because of the currency is quoted in pairs and impact on the pair could be similar. Eventually, the more dominating event will set the direction for the pair. Countries with higher interest rates tend to have stronger currencies and vice versa. Lower the trade deficit of the country. Stronger is the country's currency. Higher inflation leads to strengthening of currency and vice versa. Knowing the cause and effect of events on currencies helps while trading currencies. Please select desired text on the website first. You can also select text. Open a ZERODHA account. Chapter 3. Impact of events Brexit and interest rate parity. 3.1 Brexit. The event extraordinaire. I originally planned to dedicate this entire chapter to the USD-INR pair, which as you may know is the largest traded currency contract in India. But then, the Brexit issue happened today and I can't help writing about it as it has a huge relevance to what we just discussed in the previous chapter, events and their impact on currency pairs. To give you a sense of what happened, have a look at how the Great Britain pound GBP reacted to the event. It was down a massive 8.64%, which you will eventually realize is a big deal in currencies. The Guardian UK had this to say about the event. Here is the article. My objective here is to simplify Brexit to the best of my knowledge and help you understand why the pound reacted the way it did. Obviously, the bigger agenda here is to help you understand the potential impact of such events on currencies. By doing so, you'll get a grip on how to summarize global events such as Brexit and understand what kind of impact they could have on currencies. For the sake of simplicity and brevity, let me bullet point Brexit for you. We start with a bit of history. After the World War II, Germany and France debated the idea of forming a union of sorts. The thought process was that if countries traded and did business together, then they are less likely to wage war against each other. This laid the foundation for forming a bigger union called the European Union (EU), with more European countries agreeing to join the EU. The EU formed a single market of sorts where goods, service, and people moved easily across countries. So much so that the EU decided to have its own currency called the Euro. UK, although was a part of the EU, never accepted Euro as their currency. Note there are many other countries in the EU which still have their own currency. Example, Switzerland, Czech Republic, Denmark, etc. There was a growing debate in UK in the recent times on whether the UK should remain in the EU. Many of UK's citizens believed that UK was better off outside the Union as the rules laid out by the EU Commission was more taxing on UK citizens than actually benefiting them. In simpler words, they believed they would progress faster and better economically and as a society, being outside the EU. Britain's option to exit from the EU was called Brexit. The UK decided to formally seek its citizens' vote on the 23rd of June 2016, wherein the citizen would vote for being in or leaving the EU. This is called a referendum. The outcome of the referendum was a bit of a shocker, with the UK actually deciding to opt out of the EU. In fact, many in the UK and the world believed that UK would vote to stay in the EU. The referendum's outcome sent a shiver down the spine for traders and investors around the globe. The GBP crashed to a 31-year low. The major European indices dove close to 8 to 10%. Now, why did this happen? Why did the markets fall? What is the GBP crashed to a 31-year low. The major European indices dove close to 8 to 10%. Now, why did this happen? Why did the markets fall? What is the connection between Brexit and the currency markets and the work markets? Now here is where I'm hoping the previous chapter comes to help us, Jay. Recall in the previous chapter we discussed how a strong economy, defined by inflation, interest rates, trade deficit, etc., leads to a strong currency. Given this, think about the UK. Clearly UK is one of the strongest economies in the world and contributes significantly to the EU. Now with UK opting out of the EU, things are set to change both economically and politically. While UK has a trade deficit with the rest of the world, it maintains a trade surplus with the EU. This should give you a sense of how strongly the UK's economy is coupled with EU, with UK opting out of the EU. Its finances are certainly going to take a hit. Further, the problem is with clarity. Everyone knows that the economic situation is bound to change. But to what extent is something no one really knows. How will the Bank of England react? Will they cut the rates to near zero? Uncertainty is one thing that the market despises. And given its nature, Brexit has many. Therefore, as a result, the market's cracked. You as a currency trader should be in a position to study the event and understand some basics. From my experience, sometimes the best trades are set up backed by simple common sense and basic knowledge. Remember, if you had studied the event and arrived at a conclusion to not take on a trade, then that in itself would have been a good trade. As the rule of thumb says, when in confusion, do nothing. The point is, when you have events of this magnitude around the corner, it is mandatory for you to know what is happening. Taking on a trade without the requisite knowledge is equivalent to a blind speculative bet. So, that's about Brexit and how events like this can impact the currencies. Let us move ahead to figure out few other currency concepts. 3.2 Fair trade. Imagine a perfect world wherein you can borrow money at a certain interest rate, invest the borrowed money at a higher rate, and earn the differential in the rates. Confusing. Let me give you an example to simplify this. The interest rate in the United States is about 0.5%, arguably one of the lowest in the world. Assume you borrow $10,000 from a bank in the United States at 0.5%. Invest this borrowed money in a country like India where the interest rate is about 6 to 7%. To do this, you will have to convert the borrowed money, which is in USD, to INR. At today's conversion rate, a US dollar gets you 67 Indian rupees. Therefore, $10,000 fetch is 670,000 rupees per. We invest the converted money in India at say 7%. At the end of the invested year, we get back 7% interest plus the initial capital. This would be 670,000 plus 670,000 asterisk 7%. Equals 670,000 plus 46,900. Equals 716,900 rupees per. We convert this money to USD. Assume the conversion rate is 67. We get back $10,700. We now have to repay the principal amount plus 0.5% in interest. This would be $10,000 plus $50. So after repaying back $10,050, we get to retain $650. Which if you realize is a risk-free gain. If you realize $650 is the interest rate differential times the borrowed money. 10,000 asterisk 7% to 0.5%. 10,000 asterisk 6.5%. 650. This is a simple case of arbitrage. Quite easy to implement. Don't you think so? Given this, imagine a situation where you could borrow large amounts of money from US and invest this large amount in India and make potloads of money year on year, right? Well, sorry to burst the bubble. Such trades happen only in fairy tales, Jay. In the world we live in, such easy risk-free profits does not exist. Even if it did, it would vanish before even you realize. However, the bigger question we need to answer is, why is this fairy trade not possible? 3.3 Forward premia and interest rate parity. The problem with the above trade is that there are one too many assumptions. We assumed we could borrow unlimited amounts of money in US. We could deposit unlimited amounts of money in India. There is no cost of transaction, no taxes, easy movement of currency between countries. Most importantly, we assumed the conversion rate stayed flat at 67 after 1 year. Given that such arbitrage cannot exist for long, the currency rate a year later should be such that it would prohibit the arbitrage to exist. In other words, the money we received from India a year later equals money we repay to banks in US a year later. From the example we discussed above, we borrowed $10,000 from US, invested the same in India, and a year later we received 716,900 rupees per. For the arbitrage to not exist, At the end of 1 year, 716,900 rupees per should be equal to $10,050. This means the conversion rate should be 716,910,050ths equals 71.33. This is called the forward premia in the currency world. The approximate formula to calculate the forward premia is F equals S asterisk 1 plus ROC asterisk N 1 plus RBC asterisk N, where F equals future rate, S equals today's spot rate, N equals period in years, ROC equals interest rate in quotation currency, RBC equals interest rate in base currency. Let's apply this formula to check if we get the forward rate right for the above situation. Remember the spot rate is 67. F equals 67 asterisk 1 plus 7% asterisk 1, 1 plus 0.5% asterisk 1 equals 71.33. Further, note that the forward premia rate is approximately equal to the spot rate plus spot times the difference in interest rate, i.e. dash. F equals S asterisk 1 plus difference in interest rates equals 67 asterisk 1 plus 7% to 0.5% equals 67 asterisk 1 plus 6.5% equals 71.35. This is called the interest rate parity. Think about this: Indian rupees is trading at 67 today compared to 71.35 in the future. Therefore, the rupee is considered to be at a discount now. Generally speaking, the future value of any currency which has a higher interest rate is at a discount to a currency which has a lower interest rate. So why are we discussing all this, and what is the relevance to currency trading? Well, the forward premia plays an important role in determining the future's price. We will discuss more on this going forward. Key takeaways from this chapter. Events like Brexit tend to have extraordinary influence on currencies. A country whose economy is expected to suffer tends to have a weaker currency. Forward premia is the expected spot rate over a given period. Forward premia equals S asterisk 1 plus ROC asterisk N 1 plus RBC asterisk N. Interest rate parity indicated that the forward premia is approximately equal to the spot rate plus spot times the difference in interest rate. Future value of any currency which has a higher interest rate is at a discount to a currency which has a lower interest rate. Please select desired text on the website first. You can also open a ZERODHA account. Chapter 4. The USD-INR Pair, Part 1. 4.1 The Contract. We make an extremely critical assumption at this stage. We will assume you are familiar with how future and option contracts work. Technical analysis plays an important role in setting up short-term currency trades. So we'll assume you know technical analysis as well. If you are not familiar with these topics, then I'd strongly suggest you to read through these modules before proceeding further. The currency and commodities market is largely a futures market. Hence, a working knowledge of these derivative instruments is the key. Now, assuming you understand these concepts fairly well, let us begin by slicing and dicing the USD-INR futures contract. The contract specification of the USD-INR futures gives us insights on the trade logistics. Here are the salient features of the USD-INR pair. Particular details. Remark. Lot size $1,000 in equity derivatives. Lot is number of shares, but here it's a dollar amount. Underlying the rate of Indian rupee against one United States dollar. Tick size 0.25 paise, or in rupee terms INR 0.0025. Trading hours Monday to Friday between 9 a.m. to 5 p.m. Expiry cycle up to 12-month contracts. Note: equity derivatives have an expiry up to 3 months. Last trading day contracts trades till 12:30 p.m. 2 days prior to the last working day, equity derivatives continue to trade till 3:30 p.m. of the expiry day. Final settlement day, last working day of the month. Margin span plus exposure. Usually SAPN is about 1.5%, and exposure is around 1%. Hence roughly about 2.5% is the overall margin requirement. Settlement price RBI reference rate on the day of final settlement, closing price of spot. To give you a sense of how this works, let's take an example. This is the 15-minute chart of the USD-INR pair. As you can see, the encircled candle has formed a bearish Marubozu. One can initiate a short trade based on this, keeping the high of the Marubozu as the stop loss. Note that I'm not trying to justify a trade here. My objective is to showcase how the USD-INR contract works. The trade details are as below. Date: the 1st of July 2016. Position: short. Entry 67.6900. SL 67.7500. Number of lots to short 10. One lot of USD-INR equals $1,000. Contract value of one lot of USD-INR equals lot size asterisk price equals 1,000 asterisk 67.7000 equals 67,700. The margin required for this can be fetched from Zerodha's margin calculator. Here is the snapshot of the same. As you can see, the margin required to initiate a fresh position in USD-INR is about 1,524 rupees per. Therefore, on a contract size of 67,700, this works out to 1,525 67,700 equals 2.251%. Out of this, I'm guessing about 1.5% would be SAPN margin requirement, read as minimum margin required as per exchange, and the rest is exposure margin. Further, the idea is to short 10 lots. Hence total margin required is 10 asterisk 1525 equals 15,250. A point to note here: when trading equity futures, one has to earmark anywhere between 15% and 65% of the contract value as margins. This obviously varies from stock to stock. In contrast to equities, the margin charged in currencies is way lower. This should give you a sense of how leveraged currency trading really is. On the other hand, currency sticks to a tight trading range compared to equities. Hence higher leverage. 4.2 The contract logistics. Notice how the currency futures are quoted. They go up to the fourth decimal digit. There is a reason for this when it comes to currency futures. A number as small as this 0.0025 is considered big. When RBI states the reference rate, they quote up to the fourth decimal. Even a minor difference at the fourth decimal can alter the foreign reserves by a large degree. In fact, it is a norm world over to quote the currency to fourth decimal. In case of USD-INR, this is 0.0025. This is called the tick size, or in currency parlance, a pip. A pip tick is the minimum number of points by which a currency can move. So when the USD-INR moved from 67.9000 to 67.9025, it is said that the currency has moved up by a pip. How much money would you make per pip in the USD-INR pair? Well, this should be easy to figure out. Lot size asterisk pip tick size equals 1,000 asterisk 0.0025 equals 2.5. This means to say, for every pip or every tick movement you make 2 rupees and 50 paise per. Going back to the short trade, here is how the Marubozu panned out. After initiating the short, the currency pair declined 67.6000. If I choose to close this position, here is how much I would make. Entry equals 67.6900. CMP equals 67.6000. Total number of points equals 67.690 to 67.600 equals 0.0900. Position, short. This could be a bit tricky. Do pay attention. A pip, as you know, is the minimum number of points the currency can move. To know how many pips a currency has moved when it moved by 0.09 paise, We divide the total number of points moved by the pip size. Number of pips equals 0.0900, 0.0025, equals 36. As you can see, the trade managed to capture 36 pips. Let us now calculate how much money one would make. Lot size asterisk number of lots asterisk number of pips asterisk tick size. We know number of pips asterisk tick size is as good as the total number of points caught with this trade. Therefore, we can restate the above formula. Lot size asterisk number of lots asterisk total number of points equals 1000 asterisk 10 asterisk 0.0900 equals 900. Remember, this is an intraday trade. What if you were to carry this forward to expiry? Well, we can carry this forward as long as we maintain the adequate margin requirements. The July contract will stay in series 2 days prior to the last working day of the month. Here is the calendar. So the 29th of July happens to be the last working day of the month. Hence the 27th of July will be the expiry of this series. In fact, you can hold the contract only till 12:30 p.m. on the 27th of July. Of course, you can always look at the contract to see the exact date of the expiry. Another question at this stage: at what price will the settlement happen? The settlement will happen at the RBI reference rate set for the 27th of July. And it is important to note that the P&L will be settled in INR. So for example, if I hold this position till 12:30 p.m. on the 27th of July and let it expire, assume the price is 67.4000, then I'd stand to make equals 1000 asterisk 0.29 asterisk 10 equals 2,900. And this money will be credited to my trading account on the 28th of July 2016. Needless to say, as long as you hold the contract, your position will be marked to market M2M. This is similar to the way it works for equity futures. Hopefully this example should give you a sense of how the logistics for the currency futures work. Let us quickly run through the USD INR options contract. 4.3 USD INR options contract. Let us have a look at how the USD INR option contract is structured. You may be interested to know that the option contract is made available only for the USD INR pair. Hopefully going forward we could see option contracts on other currency pairs as well. Well, most of the parameters are similar to the future contract. There are a few features specific to option contracts. Option expiry style, European. Premium, quoted in INR. Contract cycle, while the future contracts are available for 12 months forward. The option contracts are available just 3 months forward. This is similar to equity derivatives. So, since we are in July, contracts are available for July, August, and September. Strikes available 12 in the money, 12 out of the money, and 1 near the money option. So this is roughly 25 strikes available for you to pick and choose from. Of course, more options are added based on how the market behaves. Strikes are available at every 0.25 paisa intervals. Settlement, settled in INR based on the settlement price RBI reference rate on expiry date. Let's have a look at the USD INR option contract and figure out the logistics. Have a look at the following image. From the option quote, we know the following. Option type, call option. Strike 67.0000. Spot price, CRBI reference rate, 67.1848. Expiry date, the 27th of July 2016. Position, long. Premium 0.7400, quoted in INR. We know the lot size is $1,000. Although the lot size has not been mentioned in the quote above. Usually this information is made available in the quote for equity derivatives. So if you are seeing this for the first time, just be aware that the lot size is $1,000. Now, if you were to buy this option, what would be the premium outlay? Well, This is fairly easy to calculate. Premium to be paid equals lot size asterisk premium equals 1000 asterisk 0.7400 equals 740. The option contract works similar to the equity derivative contracts. Here is another snapshot I captured. As you can see, the premium has shot up, and I can choose to close my trade right away. If I did, here is how much I would make. Equals 1000 asterisk 0.7750 equals 775. This translated to a profit of 775 to 740 equals 35 per lot. What if you were to sell this option instead? Well, you know that option selling requires you to deposit margins. You can use Zeroda's F&O margin calculator to get an estimate on the margin required. Have a look at the snapshot below. I've used the calculator to identify the margin required to write short this option. As you can see, the margin required is 2,390 rupees per. I hope this chapter gives you a basic sense of how the USD INR contracts are designed. In the next chapter, we will try and discuss some quantitative aspects of the USD INR pair, and perhaps look at the contract specification of other currency pairs. Key takeaways from this chapter. The contract specification specs out the logistics of the USD INR derivative. Lot size is fixed to $1,000, but this can be changed by the exchange anytime. Expiry of the USD INR contract is 2 days prior to the last working day of the month. The contract can be traded till 12:30 p.m. Margins applicable equals span plus exposure. Usually the margins add up to 2.25 to 2.5%. Currency pairs are quoted up to the 4th decimal place. A pip is the minimum price moment allowed in a currency. Currency options are European in nature. The premium quoted in currency options is in INR. Strikes are available at every 25 paisa price difference. Margins are blocked when you intend to write currency options. 69 responses to the USD INR pair. Open a ZERODHA account. Chapter 5. The USD INR pair Part 2. 5.1 Futures Calendar Spread. All else equal, the futures contract is always supposed to trade at a premium to the spot. This, as we know, can be attributed to the interest rate factor, cost of carry, in the futures pricing formula. We have discussed this earlier in the futures module. Any variation in this equation leads to an arbitrage opportunity. For a quick low-level recap on that, consider this scenario where there is arbitrage opportunity between spot and futures. Futures trade at a lower price. Assume the spot price is at 100. And the fair value of its future is at 105. Fair value of the future can be calculated using the futures pricing formula. The no arbitrage spread is the difference between spot and futures fair value, i.e. 105 to 100 equals 5. Given this, for whatever reasons, read as market mispricing. Assume the future is trading at 98. This leads to a spread of 105 to 98 between the spot and future, which can be captured. All one has to do is buy the future at 98 and simultaneously sell the spot at 100. We know upon expiry, the futures and the spot will converge and therefore the spread gets captured. If you are unable to understand the above clearly, I'd encourage you to read the chapter from the futures module, link posted above. Likewise, if the futures trade at a higher price over and above its fair value, then one can capture the spread by selling the futures and buying the spot. We have learned this before and this is quite straightforward. However, when it comes to the USD INR contract, for practical reasons such arbitrage trades involving spot and futures cannot be executed. This is because the USD INR spot market is not really accessible to the retail. So how does one trade the spreads in the currency segment? Well, this is fairly easy, as opposed to spot future spread. one has to identify the spread between two different future contracts expiring over two different dates. This is also known as the calendar spread. In a calendar spread, you decide whether the spread between two futures contract is considered normal or otherwise. All else equal, the long-dated futures contract will always trade at a premium over the short-term dated futures contract. For example, August month futures contract is expected to trade at a premium when compared to July month. Therefore, a certain amount of spread between these two contracts is deemed normal. However, there could be situations where the spread goes beyond normal, either higher or lower, and this is when opportunities arises. As of today, the USD-INR July futures is trading at 67.3075 and the August contract is trading at 67.6900. The spread is calculated as the difference between the two futures contract. 67.6900 to 67.3075 equals 0.3825. Now assume, for whatever reason, you think this spread of 0.3825 high, and it should ideally be 0.2000 as opposed to 0.3825. This means you have an arbitrage opportunity here, and you stand to make 0.3825 to 0.2000 equals 0.1825. To capture the spread, you are required to buy the July futures and simultaneously sell the August futures. Long July futures at 67.3075. Short August futures at 67.6900. When you set up a trade wherein you are long current expiry and short a further term expiry, it is also called future bull spread. Likewise, a futures bear spread is when you are required to short the current month expiry and go long on the further month expiry. Anyway, once you set up the future bull spread, you will have to monitor the trade and close the position when the spread converges to 0.2000 or lower. You will profit when one of the following things happen: when the July long leg rises and August short leg falls, when the long leg rises and the short leg remains unchanged, when the long leg rises and short leg rises, albeit at a lower rate, when the short leg falls faster than the long leg, when the long leg remains unchanged and short leg falls. Will the spread converge? If yes, then when will it converge? Why should it converge? Will one of the above situations really pan out? Well, the answer to this really depends on how well you know the spread. And for you to know the spread really well, you need to backtest it. Techniques of backtesting are perhaps a topic for another day. However, I'd like to show you how easy it is to buy-sell the spread from your trading terminal. 5.2 Executing the spread. How would it be if you could directly buy or sell the spread? For example, in the above case, we concluded 0.3825 is an overpriced spread. To capture this spread, you execute two orders, i.e. buy July futures and sell August futures. Executing these trades has some inefficiency, mainly in terms of execution risk. By the time you sell both the contracts, the prices could move, and thereby the spread may no longer look attractive. Given this, it would be really convenient to buy the spreads directly and not really deal with two different contracts. If you are a Zero customer, you have access to Nest Trader, from which you can trade the spread directly. Of course, going forward, this will also be available in both Pi and Kite. Here are a series of snapshots which will help you trade the spreads directly. Look at the part highlighted in red. As you may have realized, this snapshot is from the Market Watch. Starting from the left, we select Spread from the drop-down which specifies that we are looking at spread contracts. After selecting Spreads, we choose CDS from the drop-down to indicate currency derivatives as the segment. FUTCUR indicates that within CDS spreads, we are interested in future contracts. USD-INR indicates that we are interested in the USD-INR contracts. The full view of the drop-down menu is visible here. As you can see, there are many different spreads available. However, we are only interested in the July-August spread. which is what we have selected. Once we configure the above market watch, we submit this to load the spread. Here is how it looks like. I've highlighted the spread's last traded price. As you can see, this particular spread instrument just denotes the spread between July and August contract. Note, the spread should be trading at 0.3825 and not really 0.3700, right? Why do you think there is a difference in price? I'll try and explain this from my own understanding. I could be wrong. Therefore, comments are more than welcome. Also, we are digressing a bit here, so try not to lose focus on the main topic, i.e. how to trade the spreads. Have a look at the snapshot below. The market watch has July, August and the July-August spread contract loaded. Forget about the spread contract for now. Assume you want to set up a future bull spread by July. Sell August contract. Then you essentially buy July contract at the ask rate 67.3100. Sell August contract at the bid rate 67.6775. Spread equals 67.6775 to 67.3100 equals 0.3675. Now, if you were to set up a future bear spread, then you essentially buy August contract at ask rate 67.6850. Sell July contract at bid rate 67.3075. Spread equals 67.6850 to 67.3075 equals 0.3775. As you can see, there are two spreads possible based on what you intend to do, i.e. future bull bear spread. Now the question is, which price should the spread reflect? Would it be that of the future bull spread or the future bear spread? My guess is that the spread trades close to the average of the two spreads. In this case, average is 0.3725, and the actual market spread is 0.3700. Why 0.3700 and not really 0.3725? I'd attribute this to one of the two things: the latest quote has not been captured by the terminal, or lack of liquidity. A different explanation here could be that the spread itself is mispriced. Anyway, back to the main topic, i.e. buying, selling the spread. Once the spread instrument is loaded, all you need to do is select the instrument from your market watch and press F1 or F2 for buying and selling respectively. This is what you see upon invoking the buy order window. The window is pre-populated with the spread details. You may just want to edit the quantity bit to suit your lot size requirement. Press submit to place the order. As simple as that. 5.3 USD Inr Stats. I thought it would be interesting to study some statistics on the USD Inr pair. I downloaded the USD Inr spot data from the RBI site. Let us start by looking at the long-term chart of the USD Inr over the last 8 years, July 2008 to July 2016. Clearly, the US dollar has strengthened against the Indian rupee over the last 8 years. Quite intuitive, as our economy has literally stagnated over these years, smiley face. Have a look at the daily return plot of the USD Inr. We can observe few interesting parameters from this. The average daily return of USD Inr is about 0.025%. The maximum and minimum daily return stands at plus 4.01% and minus 2.962%. Contrast this with Nifty 50's maximum and minimum daily return of plus 3.81% and minus 5.92%. You will realize that the USD Inr pair is a lot less volatility compared to Nifty 50 or in fact any other indices. This fact is further manifested in the volatility numbers. Daily standard deviation, last 8 years, 0.567%. Daily standard deviation, 2015, 0.311%. Annualized standard deviation, 2015, 4.94%. These numbers are clearly much lower compared to the Nifty 50's daily volatility and annualized volatility number of 0.82% and 15.71% respectively. Further, I'd also ran a correlation function on Nifty 50 and USD-INR. Before I tell you the answer, I want you to take a guess on what this correlation would be like. For those of you who don't know what correlation is, here's a quick explanation. Correlation between two variables gives us a sense of how two variables move with respect to each other. Correlation is measured as a number which varies between -1 to +1. For example, if the correlation between two variables is plus 0.75, then it tells us two things. The plus preceding the number tell us that they both are positively correlated, i.e. they move in the same direction. The actual number gives us a sense of the strength of this movement. In a loose sense, the closer it is to +1 or -1, the higher is the tendency for the two variables to move in tandem. A correlation of 0 suggests that the two variables are not related to each other. From the above, we know a correlation of plus 0.75 suggests that the two variables move not only in the same direction, but also tend to move together closely. Note, the correlation does not suggest the extent of the move. All it suggests is that the move in the same direction is likely to happen. For example, if stock A moves 3%, and the correlation between stock A and stock B is plus 0.75, then it does not mean that stock B will also move by 3%. All that the correlation suggests is that stock B will move up positively, just like stock A. But there is another twist here. Suppose stock A and stock B are correlated at 0.75, and the daily average return of stock A and stock B is 0.9% to 1.2%. Then it can be said that on any given day, if stock A moves above its daily average return of 0.9%, then stock B is also likely to move higher than its daily average return of 1.2%. Likewise, a correlation of -0.75 indicates that the two variables move in opposite directions, indicated by the V sign. Suppose stock A moves up by plus 2.5%. Then by virtue of correlation, we know that stock B is likely to come down. But by what degree will it come down isn't known. While we are at it, one more point on correlation. This bit is only for those interested in the maths of correlation. The correlation data makes sense only if the data series is stationary around the mean. What does this mean? Well, it simply means that the dataset should be sticking close to the average values. Take another look at the graph of the daily returns of the USD-INR. Reposting the same for your convenience. The daily average return here is 0.025%. And if you notice the daily returns, it is mean reverting in nature, meaning even if the returns shoots up or comes down, it eventually sticks back to the average value. A data series which exhibits such a property is said to be stationary around the mean. Stock, commodity, currency returns are invariably stationary. But the stock, commodity, currency prices are not stationary as they tend to trend. Confusing? Well, the key point that you need to remember here is that when you run a correlation test, make sure you run it on the daily returns as they are stationary and not really on the daily prices as they tend to trend. Calculating correlation between two variables is quite easy. In fact, has just two steps. Calculate the daily returns. Use the equals correlate function in Excel. Press enter and you get the correlation between the two variables. Remember, correlation between stock A and stock B is the same as correlation between stock B and stock A. I hope you've had a decent understanding on correlation. It's time I repost the question asked earlier. If you were to guess the correlation between USD-INR and Nifty 50, what would it be? Forget about the number. Can you at least guess whether they are positively correlated or negatively correlated? Let us try and deduce this. If the markets, as a representation of the whole economy, are doing good, then the markets tends to attract investments from overseas. This means dollars are coming into the country. The dollars get sold to get converted to rupee. Essentially, this translates to dollars being sold for rupees. Naturally, the rupee strengthens. This means the USD-INR goes down while the Nifty 50 increases. The same logic can be applied when you look at it from the other way, i.e. market going down while USD-INR increases. This means Nifty 50 and the USD-INR should be inversely correlated. In fact, this is true. And the correlation value is minus 0.12267, 2015 data. You can download the Excel sheet. In the next chapter we will briefly look into other currency contracts and the role of technical analysis while trading currencies. And with this discussion, we will wrap up currencies and start exploring the world of commodities. Key takeaways from this chapter. The classic future spot arbitrage is not really accessible to the retail market. Hence, traders tend to look at calendar spreads. In a calendar spread, you simultaneously buy and sell contracts belonging to two different expires. Future bull spread is when you buy near-month futures and sell the further month expiry. Futures bear spread is when you sell near-month futures and buy the further month expiry. You can directly trade the spread from your trading terminal. These are called the spread contracts. The USD-INR pair tends to have lower volatility when compared to Nifty 50. The USD-INR and Nifty 50 are inversely correlated. For